We interact with banks pretty much every single day. But have you ever stopped to think about what's really going on inside? Today, we're pulling back the curtain, going past the ATMs and the friendly tellers to really get under the hood of a commercial bank. We're going to see how they're changing, how they actually make money, and how that affects, well, everything. Let's dive in. So, here's our game plan. First, we'll tackle a weird puzzle. Why are there fewer banks, but way more branches? Then we'll look at a bank's financial DNA. After that, we'll get into their main business, the art of making a loan, before we uncover all the other ways they bring in cash. And finally, we'll see how they keep score and measure success. All right, first up, let's talk about a huge trend that has totally reshaped banking in the US. It's all about consolidation.
Okay, so here's a question that might have crossed your mind. We keep hearing about banks merging and the industry getting smaller, but then you walk down the street and it feels like there's a bank branch on literally every single corner. So what's the deal? How can both of those things be true?
Well, just look at this number. It's staggering, right? Back in the mid-80s, the US had over 15,000 different commercial banks. Today, that number's been slashed to around 6,600. That is a massive industry-changing drop. So what happened? You can see the answer right here on this chart. It was a merger frenzy. Starting in the 80s and really exploding in the 90s, bigger banks just started swallowing up smaller ones. It wasn't a slow trickle. It was a flood of acquisitions that fundamentally changed the landscape and shrank the number of independent players. And what opened the floodgates? One word: deregulation. See, before 1994, banking was a very local affair. But this one act basically erased the state lines for banks. It let them merge with competitors in other states and, crucially, open up branches wherever they wanted. So there it is. We have fewer banks, but the big ones that are left can put more branches all over the place. Paradox solved. Okay, so now we get the big picture of the industry. Let's zoom in and get into the nitty-gritty of how an individual bank actually works. And to do that, you gotta look at its financial blueprint, the balance sheet. Everything, and I mean everything a bank does, comes down to this one simple equation. On one side, you've got assets, that's all the stuff the bank owns, and that has to perfectly balance with the other side. Liabilities, what the bank owes to other people, plus capital, which is the skin in the game from the bank's owners. It's like the ultimate report card of a bank's health. Here's a really simple way to think about it. The balance sheet is just a story about the flow of money. On one side, you have the sources of funds. This is where the money comes from. Think deposits and owner investments. On the other side, you have the uses of funds. This is where the money goes, things like loans and investments. The basic business model is just taking money in and then putting it to work somewhere else to make more money. So where does most of this money actually come from? Well, take a look. 2/3. A full 66% of a typical bank's funding comes from people like you and me, from our deposits. Your checking account, your savings account, that's the primary fuel that makes the entire banking engine run. And what do they do with all our money? Well, first and foremost, they lend it out. Making loans is their bread and butter. They also buy stuff like government bonds and other securities to get a nice, steady income. And cash? They try to hold as little of that as possible. Why? Because cash sitting in a vault is dead money. It's not earning any interest, so it's not making them a profit. Okay, let's zoom in on that number one activity, making loans. This is truly the heart of banking. It's where all the analysis, all the judgment, and all the risk really come into play. And don't underestimate how important this is. Figuring out who gets a loan and what interest rate they should pay, well, that decision can literally make or break a bank. If you get it right, you've got a profitable business. If you get it wrong and people stop paying you back, you could sink the entire ship. So how do they make these big decisions? Well, for generations, bankers have used a classic checklist, the 5 C's of credit. First, they look at your character. Do you have a history of paying your bills? Are you reliable? Then capacity. Do you actually have the cash flow to make the payments? Next is capital. What's your financial cushion look like? What happens if you lose your job? Then collateral. What can they take if you don't pay? And finally, conditions. What's the economy like right now? Is it a good time to be lending money? Now, you might be thinking, my bank doesn't ask me all that. And you're right. Today, those 5 C's have been supercharged and automated into what we all know as a credit score. Complex algorithms crunch all the numbers on your credit report to spit out one single score. It's what allows for those instant loan decisions we're all used to, but believe me, deep down, it's still trying to answer those same 5 questions. And this table right here is a perfect example of how it all works. So check it out. You've got a small firm and a large firm. Both start with the same 7% base rate. But then the bank adds a 3% risk premium for the little guy and only 2% for the big, stable company. The small firm gets dinged again for the loan's term and some competitive factors. The end result? The big firm pays 9%, while the small business pays almost 12%. It's all about perceived risk. So loans are clearly the main event, but a modern bank is so much more than just a lender. It's really evolved into a kind of financial supermarket where you can get a whole bunch of different products and services under one roof. A huge part of this is the boom in services where the bank just collects a fee. Stuff like managing wealthy people's money, selling you mutual funds, or even acting as a back office for smaller banks. Now, what's so great about these for the bank? Well, they generate a nice, steady stream of income without taking on all the risk that comes with lending money. It's a win-win. And this is the legal structure that makes that whole supermarket idea possible. It's called a financial holding company, or FHC. You can think of it like a big corporate umbrella. Under that one umbrella, a single parent company can own a regular bank, an investment bank that deals with stocks, and even an insurance company. This is the blueprint for the modern financial giant. So with all this going on, loans, investments, fees, different companies under one roof, how does anybody, from investors to regulators, actually know if a bank is performing well? Well, let's look at the key stats they use to keep score. The first big one is return on average assets, or ROAA. Think of this as the bank's efficiency score. It basically asks, for every single dollar of assets you have, that's every loan, every bond, every building, how many cents of profit are you able to squeeze out of it? It's the ultimate measure of how well the bank is being managed day to day. But then there's the other key metric, return on average equity, or ROAE. Now this one tells a different story. This is the one that the bank's owners, the shareholders, care about the most. It answers a simple question. For every dollar that we invested in this bank, how much profit are you making for us? This is the bottom line number for investors. And that really brings us to the big final question, doesn't it? We've seen how banks have consolidated into these massive giants and how they've turned into these complex financial supermarkets. So what does that all mean for you and me? Does it give us more choices and better technology? Or does it create these massive institutions that are just too big to fail? It's something we're thinking about. Thanks for tuning in.